So on a present value basis, they make more money. That's why when interest rates are high, leasing is actually better, ends up being a better deal for customers. But if interest rates are practically zero, there's not too much benefit to postponing those. On the other hand, if the present value of those lease payments that you're making is above, I think, 70%, it may have changed over time. We don't actually consider that an operating lease. We consider that as a capital lease. In that case, IRS allows you to write off the depreciation and think of the present value of the payments as purchasing value. Let me check what that threshold is. Threshold for capital lease. Oh, it's 90 now, okay. And IRS is doing that because in most cases, companies that lease these products write off pretty much the entire depreciation, especially in an environment where you have accelerated depreciation write-off to the makers. That reduces their tax bill too much too fast, and IRS doesn't like that. You know, if payments exceeds 90% of it, then you effectively bought it. You just bought it in installments. IRS says, no, I'm not going to let you take advantage of the tax advantage. Especially if the leasing company and the company that leased it have differential tax rates. You could actually gain these leases and generate an extra tax benefit you wouldn't have had otherwise. That's why IRS makes a distinction. It also, it doesn't, there are certain practices, for example, in Islamic finance, on paper they are against interest payments, okay? But most of the Islamic finance of corporations goes this way. You buy a certain product, but I buy it for you, I rent it to you, and there's a minimal buyback provision at the end of the lease term. But surprisingly, the payments for those lease payments are almost the same as the payments you would have made if it was a standard mortgage type payment. That's actually a capital lease, and you know, under IRS rules, the company that's making the lease wouldn't have been able to write it off. All right. What else are we going to talk about? All right. Now let's look at these are some parenthetical items. These are basically different kind of shares, okay? Common stock, Class A, total outstanding not many, Class F, that many. No, I'm sorry, Class B, that many, and Class F, that many. Only 1 million Class F shares, but more than likely they have more voting power. You could probably find those in notes. Okay. Now let's look at the statement of operations. All right. Again, you have only 2 years worth of stuff. So if you needed more history, you need to go back and download the past thank you statements so that you can create a series. You know, revenue is revenue. Cost of revenue is basically expenses that you would have had to make those sales. You know, your hourly workers, any inputs that you needed for those, and any depreciation of the assets. They're always in there. You know, for a basically software and services company like Palantir, those numbers are not that big. In fact, probably most of that 100 million is something like depreciation, which we're going to find out later. We always look at that number, gross profit, but I'm going to actually insert a line here and calculate something called gross margin. And I want that for two reasons. Let me make that bold red, and let me indent it a little bit. Take the gross profit and divide it by sales. Of course, I'm going to express that as a percentage. And I want this number to be black and white. It's my sheet. I can do whatever I want. If you guys haven't learned anything about me by now, you know that, right? This number is important. A, it allows comparisons to past statements, because companies grow over time. Not just in terms of revenue, but you know, if they made acquisitions, even if their overall sales are the same, they grow over time. Just because their sales have increased by about 80 million quarter to quarter, doesn't necessarily mean that they've done a better job. But in this case, well, I see that their gross margin has actually increased. Gross margin is basically how much of each $100 worth of sales you get to keep before you worry about the other expenses. So these guys are keeping about $2.50 more this year compared to last year. So they are improving their gross margin. These are for 9 months, and that's going to be important for later purposes. I'm going to make these blue, because had I downloaded the 10K, in fact, let me download the last 10K. Let's go back. This is, let's go to, oops, if you click on the filing, you get the document, not the, just say open filing, come on. Okay. This is 10K, December 2022. I'm going to change the name of this file to September 2023, because November was when it was filed, not the actual date of the statement. So let's open that up. And let's go to statement of operations. I'm going to do exactly the same thing here. Oops. This is for 12-month period, so I'm going to give it a different color. Again, you know my rationale. It's my sheet. I can do whatever I want. If you're constructing a series of quarterly numbers, you kind of have to do it. The numbers you're going to get from 10Ks are 12-month numbers. Remember, statements like income statements and statements of cash flow, they're like a video that you take for a period, right? Statements like balance sheet, it's a snapshot. So it's at the end of, it's as of that date. But income statement is during that period. So if I wanted to know the 3-month numbers as of December 31, 2022, directly I'm out of luck. But I can actually go to my statement here. Sorry, where is that? Thank you. I'm gonna insert here December 31.